What's up, guys? This is Dr. Jean Denis. How are Jean Denis? Hope all is well. So I'm creating this video just to go through some of the steps of the DCF and to show you, generally speaking, what I was showing you in class, but you can pause and rewind this video just to hopefully get you through the numerous steps that it takes to complete this DCF. So I'm going to share my screen, and so in just a moment you'll be able to see one of the two spreadsheets. I'm going to use both of them to do a comparative of the different DCFs I've been demonstrating in class. And so let's start with organizing ourselves. So the instructions are on Canvas, right? Hopefully you've seen them several times. And but it's always good to see a visual, right? And so I've kind of like paraphrased the steps here on the left. So the first thing you want to do is download all the statements. So many of you have already done this. Some of you had difficulty finding them. You don't need every line item in all the statements, but what I'm showing you at the bottom is for the acquirer, this is Disney, the three main ones. For the target, the three main ones, right? So I'm going to highlight that, assuming that you've already uh, got that information. And that's going to allow you to link it to the calculations that you're going to see me do in just a few minutes. Um, so I want you to start by forecasting revenue and forecasting capital expenditures. Try to do both of them for 10 years. And I'll explain why a little bit later on. And so I'm going to show you how that's done, but you've seen this in class a couple times. So from the previous financial statement, you should be able to see a trend, a historical trend. So this is only one of the ways that you can forecast for DCF, but that's the one I'm training you guys on. It's a common one. And so we see here the last 10 years for Netflix. We see the revenue growth, right? They've done pretty well. It's been consistently going up. And then you can calculate the mean, the average growth rate over the whole period, last 5 years or the last 3 years, right? And so this highlighted in red is what we've been using for the forecast. So once again, it's aggressive. So you don't have to do that. You should do what's most appropriate for your target firm. Look at what analysts are saying. Look at the industry growth rate. You can use the industry growth rate. You can say, well, I think they're going to, for one more year, I think they're going to do well because of the acquisition. And I think they're going to taper off in year 2 or year 4 or year 5. Just try to get creative with that. But for this example, basically what we did to get the first forecasted year, we have the last reported revenue, 24,996, multiplied by 1.289. And that gives you this number here. And so from there, none of us have a crystal ball, but with this DCF, we try to integrate realistic assumptions. So if you find one that you say, Professor, I think this is a little more realistic for this industry I'm talking about, or this firm, then definitely put it in there. But we're using a historical average here, which you can put in your notes at the bottom. Next, and you can create a forecast for revenue and CapEx in the same tab, which is actually what you're going to see here. But basically for this tab, we've pasted past revenue and we found past capital expenditures. So if you remember from class, that is a metric that describes the cash flow that's used to acquire or maintain an asset. In this case, an entire company. And so you find that on the statement of cash flow or the balance sheet. And here it is right here in the past, right? And so I'm going to show you where you found the number in case someone gets lost, but 497,923. That's the last reported year here. So you go to statement of cash flow for Netflix, we see it right here. And so what we'll do next is we're going to find out how much capital expenditure has been as a percentage of revenue. So this is how much a company has been producing overall, the gross. And we're saying that we think that that might be an interesting function, an interesting percentage to forecast moving forward. So if you look at this column here, you'll see it's been about 1.5, 1.2, 1.9. And in order to do the forecast, we take the forecast of revenue that we already have, and we didn't do the projected CapEx yet, but we're basically using this number here, the last 3 years, the average of these three numbers. It's 1.45. And we're saying moving forward, we think that capital expenditure is going to be about 1.4, 1.5% of revenue. So that's how you can forecast. That's one way you can forecast your capital expenditures. So you already have one component of free cash flow. So now you're starting to rock and roll, right? So if you go to the main tab, I'm going to highlight this. So you want to forecast those for us for the next 10 years, revenue and capital expenditures. And I'm just going to put that in there. So for the last reported year of capital expenditure, this is what it is. So yeah, I linked that cell. Now we're starting to talk about earnings before interest and after tax. So that's operating income minus the taxes of the acquiring firm, the firm that now owns it. And that's to pay corporate income. So we go to the income statement for the target firm, the smaller firm, and we find this number. So Netflix income statement, we find the operating income for the last reported year. In this case, you guys are looking at last year, 2024. And it's 4,585,289. That's this number here. We found the last reported year of operating income. Hopefully you're not at a loss. You're not starting off strong for a DCF, but hopefully you have a positive operating income. And we're basically, if you look at what I have up here, we link the cell and we multiply that by one minus the taxes of the bigger firm. So you have to find the effective tax rate of the acquiring firm, right? So we have this number here, and we're finding it as a percentage of revenue, 14.68. So earnings obviously is not going to be nowhere near revenue because there's a lot of deductions are coming out to produce, to sell, right? But what we can do is we can just link the cell right here, and we're halfway done with free cash flow for the last reported year, not for our DCF yet. We are saying that we're going to use a straight line method for depreciation. Remember, depreciation is the adjustment of value downwards for losing value over in the future. And so straight line states that over the useful life, or in this case, this forecast, that's the only thing we care about, we're going to lose about 10%. So we're going to cut it evenly throughout the next 10 years. So depreciation should be 10% of capital expenditures equals zero point 0.1 times this number above. And I want you guys to find the absolute value of depreciation because it's going to accumulate, it's going to add itself up. But and the free cash flow is considered as a positive value. So we're almost done with free cash flow. Last thing we're going to do is we're going to focus on this box here. And the net change in working capital is calculated primarily through your balance sheet. The only figure you need is your revenues, right? And so if you look at this table here in the middle, you need to find total current assets, your cash, your total current liabilities to find net working capital. And I want you to exclude cash. I want you to take out cash, find adjusted current assets. If you compare it to total current liabilities, you'll find out what your working capital is. For Netflix, it's total current liabilities are higher, right? And so the net change in working capital for last year is 554,126. So I want to stress that you can find this number. It's reported for firms for the last year of performance. But we're going to start to find the change, and that's what we're going to put for our forecast. Our forecast starts here, right? So from here, it gets relatively easy. So capital expenditures equal, we're linking it to basically the first reported year. Bam. And then we're finding earnings before interest after tax by saying, finding this percentage. So yours is going to be different. It's going to be based on what your target is as a percentage. And we're multiplying that by the forecasted revenue. So as I mentioned before, you can say, Professor, I don't think it's going to stay at 14.68. I think it's going to change. I think earnings might change based on the industry growth rate or by another driver of earnings. There are a lot of different things you can put in to do your forecast, but I'm showing you the historical average, right? And so from there, remember we had the straight line method saying 10% of capital expenditures. But instead, what we're gonna do is after we do that, we're gonna add the previous year, right? And then finally, if you see what's left is the net change in working capital. So you'll see here this table, you can easily just start doing the math here, or you can create another tab. What I'm going to do is I'm going to find these percentages at the bottom. After you find the net working capital for your target firm, you're going to find it as a percentage of revenue. Very similar to what you were doing for earnings before interest and after tax. So in order to do the forecast, I'm going to I'm going to do it here. So watch what I'm doing. So I'm going to find this percentage. In the last reported year, adjusting current assets was about 6%, 6.2%. I'm gonna multiply that by the first forecasted year of revenue. And then for the first forecasted year of total current liabilities, I'm gonna multiply that percentage by the same thing, revenue. And if I look at the difference to find net working capital, I find this number minus this number. That's your net working capital. And then the change year over year is the difference between these two numbers. And this number here, this value is what you're putting into your DCF. Bam. So I showed you how to do that. So this is 1 year forecast. So you just have to do that from 1 to 10 years. And if you notice here, I wrote the correct year for everybody's DCF. It should be 2025 to 2034, right? Now I'm gonna show you. I'm gonna go to another spreadsheet and show you. This is what it should look like. See, look what I'm highlighting here. So you'll spend some time and forecast just change of working capital for your target firm. And so this number here is what you're posting into your free cash flow, right? If you look up here, it's so 14,370. This is the number right here, right? So going back to the previous spreadsheet to keep it consistent, once you've calculated your free cash flow for 10 years, right? For 10 years, you can um, you can sum that number and you can discount it. So now you have the total free cash flow and you're almost ready to discount it. So this number here, cash flow before acquisition costs, is a summation of the four columns above it. Earnings before interest and after tax, depreciation, change in working capital, and CapEx. So you should be able to do this across the board. And then you want to start to discount those cash flows because that money's not worth as much in the future, right? That's what the time value money is all about. So your weighted average cost of capital comes into play here. You must calculate your weighted average cost of capital before you discount your cash flows. So that's why you need this table. It's widely reported, so you can find it for Polo, for Lenovo, for Nike, for Apple, what the WACC is. So we're talking about the big firm, the acquirer. You find that number, don't put it in there, and then you fill out this table. So you're going to reputable websites like Bloomberg, like Yahoo, like Treasury.gov, like Thomson Reuters, and Google Finance, you're finding these values. How much long-term debt does Acquire have? What's the market cap as of today or recent date? What's the risk-free rate? What's the 10-year UST bond? You fill all these values and then you plug it into this formula. And then it should calculate a number very similar to what most analysts look at as the cost of capital for the acquirer. It's basically how much it costs them to raise capital through equity and through debt, right? The weighted average. And so when you have that number, it's 6.5. You go back to the spreadsheet, see it's right here, 1.065. So in your first forecasted year, you're going to discount the cash flows by 1 plus the WACC. For future years, you're gonna raise this number to a power so that it's discounted even more. But to show you what we're doing, we're basically taking the total free cash flow and we're dividing it by 1 plus the WACC, and that gives you this smaller number here. See how this number here, 5,607,025, it's smaller than the undiscounted free cash flow. You're going to bring 1 plus the WACC to the second power, to the third power, all the way to the 10th power. So all this will be filled out, right? And then from there, you want to bring in what's called enterprise value. So the acquirer has to pay for the target firm. So what they're paying is there's a number of ways you can acquire a firm. You can buy out all the shares, which is buying out the market cap. You can do what's called a leverage buyout. You can pay the enterprise value. There's a lot of different ways. And so in our simulation in our DCF, we're going to say that the acquirer is paying the enterprise value. So that's something that you can actually easily look up. But what I want you guys to do is to demonstrate that you understand what's happening in there by creating a little table that's saying, Professor, this is the formula here. Enterprise value is market cap plus long-term debt. If you have preferred stock, preferred equity, you add that. If you have minority interest, you add that. If not, in the case of Disney, doesn't exist. And then you take out cash. So in this table, you see that's what I already did. It gives you this number here. So Netflix enterprise value is 247,499, and that's what Disney would have to pay to acquire it. So that number is here. That means that your first year forecasted free cash flow will be, in this case, will be negative, but you'll see a DCF with this number at year zero, which makes a lot of sense as well. Before you acquire the asset, you're paying for it. Just like when you buy a house, you pay for the house before you buy it. You pay for a car before you buy it for a piece of equipment. But I'm having here just to make it easier to sum all the cash flows and your initial investment. But you can easily put the number here. And then the net present value is a sum of all the cash flows. So I'm outlining here all the cash flows and the acquisition costs, all of it together. And that tells you your intrinsic value of this deal. From there, we're almost done. We're going to talk a little bit about this in class next week. So we've discounted cash flows, we've forecasted, we've calculated NPV. So we're talking about payback and IRR. So you see this is a negative number here. I'm going to show you this other deal, Chipotle by Shake Shack. So here we have the IRR and we have the NPV already calculated. I'll slow down and show you that the net present value here is zero, right? And the reason why it's zero is because if you look at the acquisition cost to buy Shake Shack, is basically equal to all the cash flows, all these numbers put together, right? And that equals zero. And so for Netflix, that was not the case. And so what internal rate of return means is basically it's different than ROI. It basically shows you what discount rate exists that will make all the inflows equal all the outflows, like basically an NPV of zero, right? And in this case for Shake Shack, it's 12.33. So you can do that through GoalSeek, which I can send you a link on that to do that quickly. It should take seconds. Or there's an IRR command in Excel, right? And the IRR is basically taking all the discounted cash flows and then finding out what rate sets NPV to zero. So in this case, the IRR is 12.33 and it's bigger than WACC. That's when you want to do a deal. You want an NPV of zero and you want an IRR above WACC. But we did not talk about payback yet. So let's talk about payback. So payback is an expression that reflects when will you pay this initial investment back, right? So if you buy a house, you buy a car, you buy a business, when you're going to break even. Break even means the units. Payback means paying back what you spent. And so in this case, it's 7 years and 7 months. So how does that work? Basically, if you look at all your inflows, right? Excuse me. Cash inflows are EBIT, depreciation, and net change in working capital. Capital expenditures and acquisition costs are outflows, right? In the case of Shake Shack, it's a negative number in the first year, but as these positive cash flows, these net cash flows are positive, this negative number starts to decrease. And I could it says it shows you how to do it on the spreadsheet, but you're adding this number to this number, 184,902, and it decreases this negative balance. It pays it back all the way till you get to year 7 months. In this case, where you actually turn positive. when we go back to Disney, Netflix, the payback is not within the 10-year period. So for you guys in this class, if it's over 10 years, that's all I need to know. I don't need you to calculate the payback if it's 15 years or 20 years. But for this case, without the terminal value, it's over 10 years, and you can stop there, right? Um, the last thing I want to show you is terminal value. So I'm gonna calculate, I'm gonna highlight that calculate payback and IRR. Um, so terminal value. So terminal value represents the um the value outside of the forecast period that represents selling the asset, exiting the deal, where actually there's some type of sale where you can get the value back. And so there's multiple ways to do it. The way we're showing it from an academic lens is perpetuity. So this is the formula here. Terminal value formula is the final free cash flow, right? Multiplied by 1 plus the growth rate. In this case, we're using 3%, which is the GDP growth currently, divided by your weighted average cost of capital for your acquirer minus the growth rate. So it's going to come up with a pretty big number, right? And so this is assuming that for the deal of Disney Netflix, if in the future it's sold off or there's some type of divestment and they get them and Netflix pays back Disney, that type of thing. So looking at the actual numbers for this deal, we see that the last free cash flow, which was already calculated by our team, is 31 million. So if you see this number here, right, and you put it into the formula, you get this terminal value. That's basically 31 million multiplied by 1 plus the growth rate, 1.03, divided by the WACC, which is 0.065 minus 0.03, right? So that gives you 0.035. That gives you this pretty big number, which covers this net NPV. The intrinsic value is covered after the forecast period if Disney were to sell off that asset. And so that should cover everything. You might have some questions next week, but I wanted to give you a chance to kind of see how you forecast 1 year, covering all the bases. Let me know if there's further questions on any of the steps. And I'm here to support you guys. There's a lot of value in going through these steps. I know it's arduous, I know it's long, but it's going to give you a sense to kind of really demonstrate your understanding of these terms like working capital, depreciation. How do we calculate WACC? We can even do it by hand in class. But it gives you a chance to kind of understand how business works, how deals work, how investments work, which is very important as a business professional. So I'll post this video and I'll follow up with any questions. Let me know if you have any questions when we're in class. See you guys.